So I've been waiting for this bloodbath in the bond market, right? And Zero Hedge is talking about it here. Nice article, 5 point expectations for Fed funds rate being above year end expectations. Above 5.0 went up. So more people expect Fed funds rate to be above 5% by the end of the year instead of them pivoting. Um, I think this is kind of like where the reality is going to start setting in for people in the stock market. Now, it's not that I don't think the Fed will pivot in terms of lowering um, interest rates. He will eventually. Maybe not until later this year or early next year. But what's happening now in the bond market is endemic of a bubble that really wants to collapse in on itself. And in a normal market, when your yields go up, right? Usually that means that your bonds are going down. So when bonds are going down, usually your stock market will go up. And when your yields go down or sideways, then the stocks start. So that means that when the bonds are getting a bid, the stocks go down. Or you can look at vice versa. The bonds, the stock market is driving the bond market, and that seems to me to be indicative of a more healthy economy overall. People have the capital, and they're going to, if the stock market isn't doing what they want it to do, they're going to park it in the bond market more so than the stock market. But when bonds go down in the stock market, when the bonds go up in value and the stock market goes up in value, there's something fundamentally wrong about that. There's something fundamentally unhealthy about that. Now, what happened today, what's happening over the past few days, is we're starting to see a little bit of a sell-off in bonds here. The mortgage rate shot back up to 6.3%. Now we're starting to see the 10-year creep up and all of the others follow suit. I wouldn't be surprised if the yield curve uninverts. But I think if it does uninvert, it'll remain relatively flat. But all this has to do with, more so than the Fed funds rate, is the offloading of this debt, this massive amount of debt that the Federal Reserve is holding on to, that they bought in order to keep interest rates low. Up till now, I think I had it earlier. Let me see if I can find it. Right here, let's add this guy. And let's get rid of this guy. Okay. Up till now, I want to put this in the second window. New pane below. So up to now, it seems like, as soon as the Fed started pausing on the quantitative tightening, you had a pretty big shoot up in yields. And then I think through this period, from right about here through to here, I think you had the right about to here, I would say. This is where the sell-off, that's June 2022. Let's move it ahead, actually. Yeah, so right here, then so right here is where you see the transition and the yields start going up. And then right about here is another leg up in a big way. What happened there? Well, that's when the impact of the offloading of the debt on the Fed's balance sheet really started to go into the market. And I think what's happening here in this area, maybe I can use the box. There's like a box somewhere. I think what's going on here in this area is the Treasury kind of using countermeasures. Like buying shorter dated bonds to replace the longer dated bonds and all the other stuff that they do, paying off, the bondholders instead of buying new debt. So using the Treasury general account to pay off bondholders instead of buying new debt, which is what they're supposed to be doing anyway, believe it or not. So what I think's happening now is, as you can see, every month, what happens is, like at the beginning of the month, the Fed pauses their asset purchases, and then for the rest of the month, they're selling. And what we saw last month was a pretty significant sell-off, and actually bonds went down, yields went down, maybe on these hopes of a pivot. And they're still fooling themselves into thinking that the Fed's going to pivot for no reason. I mean, the Fed will pivot eventually, but not until there's serious problems. A serious systemic issue. Although, if the stock market crashed hard enough, given that Powell is not the most fortuitous, hardy, strong-willed person from what I can tell and from his history, I would say that if you had a really bad correction in the stock market, what Powell would do most likely would be what Jared Dillon on Real Vision said earlier. He said that Powell would perhaps pause increasing the Fed's funds rate because that's going to have the biggest psychological impact, and he's going to continue to offload the debt. And that might work for a time. What we're seeing here is we had the typical beginning of month pause in the selling. They usually they usually increase their balance sheet just a smidget during that time period. Last week was the first week of offloading, and then this week is going to be the second week, and then he's supposed to go one more week after this. We'll see. Now, I think that if the bond market does bad enough this week, but it has to do really bad, then he might pause his offloading a little early. I think we're starting to see real strain in the debt market. Like Gregory Mannarino talks about a lot. It's all about the debt markets. When you start seeing bonds go down in price and the stock market go down, that to me is a sign of an unhealthy situation. Just like if they're both going up at the same time, that's obviously an artificial market. Usually if one goes up, the other goes down and vice versa. So I got a few trades here. I'm looking at maybe by the end of the week, regardless of what happens, I'll sell them. Tomorrow Powell is talking. Maybe, the stock market will like that. It seems to me like, almost as if the stock market is dependent at this point on Fed Chair Powell getting out there and making some statement. Things are really desperate when the stock market needs a single man to go out and make a statement and say basically nothing in the process. And what happens is he makes a very ambiguous statement, and people who want to believe in the bull market will read into it what they want. So the stock market could catch a bid tomorrow. I just feel like the bond market right now, even though they're not correct either, I think interest rates should be much higher in the bond market, but they're much more grounded in reality than the stock market. The stock market is mostly scams, pump and dump scams at this point, as far as I'm concerned. I was looking at ExxonMobil with a PE ratio of 8. I don't see how you can beat that. It's a huge company. It's not going anywhere. If I was to buy some stock to own it, I would maybe buy something like that. But I won't buy anything to own in this at this level in the market. I think things have to go down much, much more before I would buy anything. Same thing with crypto. Although maybe I'm missing a good opportunity there. I'm kind of, I definitely believe in crypto, but I think that it has also been artificially inflated in price. There's probably just so many money laundering schemes, that it's actually brought up the price significantly just based on money laundering. Which I love money laundering, by the way, as long as it's private citizens doing it. I don't like the government taking my money and then laundering money with it, obviously. So anyway, I think I'm just looking at this bond market. I got a few trades, a few puts, and they've done pretty good. They're not quite at double their money yet, but they're doing pretty good. By the end of the week, I just feel like, what if the Federal Reserve calls up, Bank of England and a bunch of other European banks and says, hey, I need you to buy, like $10 billion worth of bonds right now because we're in hot water and I don't want to do it. I mean, they do stuff like this. And private entities will also do stuff like this. So I firmly believe that. Well, we know that for a fact. We know that other countries buy bonds. So we can have one of these many countries. It's not going to be China, though. So that's another issue. Maybe they'll call Japan and say, hey, Japan, buy a bunch of bonds. You guys don't care about your monetary system anyway. Just buy a bunch of our bonds. So that's my worry, is I'm holding on to these options, and I timed it right, and I'm all proud of myself. But I think by the end of the week, I'm getting rid of them. I'm just a fucking boiler mechanic. I'm not some hot shot. If I can make money off an option, I don't care how much. I'm a happy camper. Just love watching this market here. This could be a really bad month for bonds. They're just at the second week of the offloading process. As you can see, with a lot of these pauses, you see kind of like more stability in the market. Right here, for example, correlates to a little dip. Right here correlates to a little dip. Always comes at the beginning of the month. Looks like they did a couple of them in the month of November, though. November was kind of like a touch and go there. So that's where I'm at with it. Just a little bit of boiler mechanic economic analysis. I am out.